If you are 30 years old and you have nothing saved for retirement, there are some little steps that you want to put into action today. That way you don't retire broke, and by the end of this video, you'll know exactly how to do that. You want to start sooner rather than later because time is one of the most important factors which will determine how wealthy you will become. Let me show you. If you started investing $500 a month the day you turned 21, and you did this until you were 35, and then you never invested another penny again, but you left this money in your investment account until you turned 65. So you invested $500 a month, which is less than the average new car payment nowadays, and you did this from 21 to 35, and then you just left whatever money was here in your investment account, and you were able to allow your money to grow by an average of 10% a year, which has been the historical stock market return. Well, you would have over $3.3 million in your investment account when you turned 65, ready to retire, and you never invested another penny after you turned 35 years old. You never put another dollar in your investment account. But what happens now if, on the alternative example, you start investing when you're 35 years old? And now, to make up for last time, what you're going to do is, instead of investing $500 a month, you invest $700 a month, and assuming that now you can get the same 10% return, well, here you're going to put in more money because you're going to invest $700 a month from the age of 35 until 65. That's 30 years of you adding money into your account, versus here, you only added money for 14 years. So you're going to put in way more money here, but because your money is invested for less time, you're only going to have just over $1.5 million in your investment account. Still a lot of money, but way less than what you could have had if you started investing sooner. Now, I get it. If you're 30 years old, you can't go back in time to when you're 21. If you're 35, you can't go back in time to when you're 21. If you're 45, you can't go back in time to when you're 21. But there's two other factors that you can control. You can control this, and you can control this. And this is why you want to start sooner rather than later, because you don't want to keep changing this. This is why you want to take advantage of wherever you are right now and start investing. And in this video, we're going to be going over what you can do right now to increase the amount of wealth that you have here. If you have little to nothing put aside for retirement, just understand that you're not alone, because right now in America, more than 1 in 4 Americans between 30 years old and 44 years old have nothing, not a penny, $0 put aside for retirement. That includes saving for retirement, investments for retirement, retirement accounts, 401ks, IRAs, nothing. More than 1 in 4 Americans between 30 and 44 have nothing put aside, and under the age of 30, well, it's even higher than that. Now, if you were to go to a financial advisor tomorrow and ask them what you should do right now with your money, that way you can become wealthy when you retire, most of them, the vast majority of financial advisors will tell you that you need to take 15 to 20% of your income now and put it into a stock market mutual fund, or put it into an index fund that gives you broad exposure to the stock market. That way you can get a decent return. That way you have some cash to retire on. Now, this works for a lot of people, but it doesn't work for me. Now, everybody has their own opinions, and I personally think that this traditional idea of retirement is stupid. I don't like the idea of working to put this cash aside, so hopefully one day I can have this big chunk of change in my investment account so I can quit my job and then do this traditional retirement. I don't like that. So I like to start by defining, what does retirement look like for me? You have to start by defining which of these 3 things will categorize you as eligible for retirement. Is it an age? Is it a wealth number, or is it a cash flow number that you need in order to be able to live this retirement? For most people, it's an age thing. As soon as I hit 65 or 67 or maybe 70, I'm going to be eligible for enough money from Social Security. That way now I can quit my job and live my life from Social Security. For then the second major group of people, it is a wealth thing. Once my IRA, once my 401k hits enough money, then I'm going to be able to retire plus Social Security. That way then I can live my life the way I want. For the minority of people, it's the cash flow thing. When I have enough income from my investments to live my life and be financially free, well, now I'm retired and I can do whatever I want, and I don't have to rely on any other stream of income because my assets are producing enough cash flow, meaning my investments are paying me enough money every single month for me to live my life. I personally hate the idea of working until a certain age and then quitting and then just doing nothing until I die. I like working. I want to work until I die, and I hope that's a long time from now, but I like working. And there's a reason why they're saying those who retire early die early, because when most people retire and then they sit on the couch and they watch TV all day with nothing to do, well, now all of a sudden you went from being this healthy person, this productive person, this active person, to being this lazy person who does nothing, and now all of a sudden you start to develop health problems. And all of a sudden you don't feel like you have the sense of purpose. And all of a sudden you start to go into depression. And all of a sudden you become miserable. How many times have we seen that happen? So for me personally, I don't want to go down that route. I like the idea of working, but I also like the idea of being financially free. And for me, that's having cash flow to fund my lifestyle. I like investing for cash flow. That's what I've been doing. That's why the majority of my investment portfolio is in cash flow producing assets, because now you can spend your money this month, and if you run out of money, well, you have more cash flow coming in next month. And if you want to buy some extra guac, you just need the extra cash flow to fund the extra guac. This is where I like to work backwards. If I know that right now I would need $70,000 a year of cash flow to be able to live my life financially free, how would I be able to get it? Well, I know that if I invest my money into cash flow producing assets, I should be able to get a 7% cash on cash return on my money. Meaning, for every dollar that I invest, I could get 7 cents of profit into my hands today from the cash flow that my assets produce. And I'll show you how to do that in just a little bit, but let me talk about working backwards first. So if I know that I could get a 7% cash on cash return on my money, this is cash in my hand without having to sell my assets, that means I would need $1 million invested today at the 7% cash on cash return to be able to get the $70,000 a year. Now, this is where so many people get discouraged, because you say, holy moly, where in the world am I going to get $1 million? Because I don't have $1 million. I don't have anything close to $1 million. I'm starting from nothing. So where am I going to get this $1 million? Well, you don't need this $1 million today. Remember, for most people, retirement planning is something you do over the course of your career. The question is now, how can you get this $1 million sooner rather than later? That way you can achieve this cash flow goal, that way we can achieve this wealth goal sooner rather than later, and then you have the decision if you want to stay at your job, if you want to quit your job, or if you want to do something completely different, because now at least you have enough cash flow to fund your lifestyle. You have the cash flow to fund your expenses, and now your job is optional. Now that we know this and you can do your own calculation, let's break it down into smaller steps, that way you know exactly what to do to make this happen. Well, there's 3 factors that you can work on which will determine how wealthy you will become. Number 1 is how many dollars you invest. Number 2 is what return you can get on these dollars. And number 3 is, like I said in the beginning of this video, the amount of time that your money is invested for. Now, we cannot adjust this. The best thing that you can do when it comes to time is start investing sooner rather than later. But the 2 things that you can control is the return that you get and the amount of money, the amount of dollars that you can invest. So let me start by talking about the dollars that you can invest. Now, if you are an investor, if you want to stay up to date on what is happening in the markets, you can join something like Market Briefs. It's a completely free newsletter that I created. It's a tool that way you can stay up to date on what's happening in the financial markets, things like the stock market, the real estate market, crypto, the economy, and our global economy, into a fun, easy to read and witty email. Even if you don't have a financial background, not only are you going to understand what's happening in the financial markets, but I promise you, you're going to look forward to reading it every morning. So if you haven't joined Market Briefs yet, it's completely free, and I'll put the link to how you can join for free down in the description below. If you want to be able to invest more dollars, there's 2 things that you can do. Option number 1 is you could go from investing, let's just say 15% of your income to potentially 25% of your income. However, there's always going to be a limit to how much money you can cut down on, because there's a limit to how much money you're earning. The second option is you can earn more money. You create a larger pie, that way you have more income coming in, that way you have more money to invest. This is you going from $50,000 a year to, say, $500,000 a year. And at first you might say, but Jaspreet, where in the world am I going to be able to earn $500,000 a year when I'm struggling enough trying to earn $50,000 a year? Well, it's going to require you to first start thinking different. Then second, believe that it's possible. When you believe it's possible, you start researching. How do I start earning more money? Watch YouTube videos. You start reading books. You start taking classes. You start trying things. This is not something that happens overnight, but if you work towards this, you can turn your annual income into your monthly income. But it's going to require a lot of work, and it's not for everybody. but if you're willing to do it, it is possible. There are more opportunities than ever before. However, if you're not in the business or don't like the idea of starting your own side hustle or starting your own business, you can also look at how can you increase your own income at your job. Maybe you work to get a bonus, a pay raise, you work to get a promotion. If you don't like the career that you're in right now, look at some certificates. There's a lot of certificates out there right now that can help you increase your income. You might have to change careers and you might have to spend a few $1,000s to get the certificate. But if you can do that, now you'll be able to earn more money. Many of these certificates allow people to earn upwards of $100,000 a year, and some of them even allow you to work from home. So you might want to check out some of these certificates. But if you ask me, and you really want to become wealthy, and you want to have the type of wealth that most people dream of, well, you're going to have to do something different. And thankfully, the internet has made it so much more accessible than ever before. And let me just show you a few examples. You have people who are making 6 figures a year that are selling slime. And you even have young kids on YouTube that are making millions of dollars a year that are making videos from their home. Now look, these are all the exception. It takes a lot of work to build a YouTube channel with 1 million subscribers or more. I can tell you from experience. However, what I'm trying to show you is that there are more opportunities than ever. If you want to earn more money, there are more opportunities than ever before. It doesn't matter what type of background you have. It doesn't matter who your parents are. It doesn't matter how you grew up. It doesn't matter what your skin color is. It doesn't matter what language you speak. If you live in a first world country, if you have the resources to watch this video, and if you have the ability to understand what I'm saying, you are blessed and you have all the resources necessary in order to earn more money. Now the question is, do you have the drive, the discipline, and the work ethic to make it happen? Because it is going to take a ton of work. You're going to have to sacrifice weekends. You're going to have to sacrifice evenings. You're going to have to sacrifice holidays. You're going to have to sacrifice vacations. You're going to have to do a lot of sacrifices in order to make the effort, in order to make the time, in order to put in the work to actually do this. Because you're going to go through a lot of failures. You're going to go through a lot of hurdles, but it is possible. So if that is the one factor, you really want to earn more money, it is possible, but you're going to have to start thinking different and you're going to have to do things that nobody else is doing, because if you keep doing what everybody else is doing, you're going to end up just like everybody else. So if you want to earn more money, that possibility is there. If you don't want to do it through your own side hustle or business, you can see how you can do it from your own job. If that doesn't work for you either, then the last option is now, how do you live smaller that way you have more money to invest? This is the most accessible and the most simple thing to do, but again, it's not easy, because you have to make more sacrifices. And there's always a balance. There's a time and place to spend less, and there's a time and place to earn more money. And depending on where you are in your financial journey, you gotta know what's right for you. So if you're trying to spend less, well, many times there are things that we need that we really don't need. We think we need things when we really don't. You need a car to get to and from work. You just want a Beamer. You need a home to live in. You just want to pay the $3,500 a month for that really nice home. You want the nice things, but sometimes your wants aren't really what your needs are, and you sell yourself on your wants, telling yourself that they're needs, when in reality, they're really not your needs. And this is where you have to decide, what do you really need, and what do you really, really need? And if you know what you really, really need, and you can get rid of the stuff that you just thought that you needed, you get rid of those real wants, well, now you have more cash to put aside towards your investments. Now the question is, where do you invest your money? Generally speaking, your lower risk investments are also going to pay you the lower returns, versus your higher risk investments have the potential to pay you higher returns. Now, is this always the case? No, it also depends on what's happening in the markets, but generally, this is the way it works. And this is where now you can decide, what is your investment goal? Do you want the cash flow? Do you want the future wealth, or do you just want to rely on Social Security? If you just want to rely on Social Security, I don't know why you're watching this video, but assuming that you want to build this wealth for yourself, the question is now, how do you do it? And does your risk tolerance align with your goals? This is where you have to be honest with yourself, and you have to look at the numbers. Use a compound interest calculator to see what type of returns you need in order to achieve your goals, and make sure that you're investing your money in a way where you can actually achieve those returns. If you put your cash in the bank in a savings account, yeah, you're going to get cash flow, but you're going to get very little cash flow. If you put your money into a traditional bank account, maybe you'll make 0.5% a year, which is really not much. If you put your cash into a high interest savings account, maybe you'll be able to earn 2.5% a year. Better than that, but still very little in terms of how you're going to actually grow your wealth Plus, you're not going to see any growth of your principal. If you put $100,000 into a high interest savings account, you might get this 2.5% return a year, meaning you might make $2,500 a year in cash flow, but your $100,000 that you invested is not going to grow. That's going to be it, because it's not invested into anything, it's just sitting there in cash. Versus if you took the $100,000 and you put it into an investment that pays you this 2.5% a year, now hopefully the goal is you get this $2,500 a year and your $100,000 investment will grow as well. That's the goal with investing your money. However, this is better than this, so if you have some extra cash that's sitting in a savings account, you might want to consider moving some of it to a high interest savings account. Now, second, if you move kind of down the risk ladder, the second option is where most financial advisors will guide people. You put your money into mutual funds, ETFs, and index funds. Now, most of the time, financial advisors are focused in on growing your principal balance, meaning growing your investment portfolio. And financial advisors have a time and place. I'm not saying don't use them. I'm saying understand your goals and make sure they align with what your financial advisor is telling you. So most of the time, not every time, but most of the time you put your money into mutual funds, ETFs, and index funds. The goal is to see your investment balance grow into a big number when you go to retirement. You hopefully will have millions of dollars when you enter retirement. Now, there are ways for you to generate cash flow through these investments as well, and this is going to require you to figure out what are the things that you're investing in. I invest into this. I have cash and savings. I have stocks. I have real estate. I own this, and I have other investments as well. You don't have to only invest in one thing, but you have to make sure that you understand what your strategy is with these individual investments. My passive strategy, I have a passive investment strategy, which I invest into ETFs. I personally like ETFs. ETFs work similar to index funds and mutual funds. These are all funds, meaning they give you exposure to a broad group of stocks. You're not investing in one company, you're investing in maybe hundreds of companies. So when you invest in this one symbol, this one mutual fund, this one ETF, this one index fund, you're getting exposure to hundreds of companies, so you have lower risk. Now, the reason why there's so many different types is because, well, they come with different rules and they have different ways that they operate. Like many times, mutual funds are actively managed, meaning these are funds that are managed by people, and so you have to pay higher fees, and the goal is that your mutual fund is going to give you higher returns. However, it's been proven time and time again that for regular people, actively managed mutual funds don't actually outperform the returns that you could get with a lower cost fund, especially after you factor in the fees. Now, ETFs and index funds work very similarly. Again, these are also funds where you can get exposure to many different stocks with one investment. However, ETFs trade just like stocks. Index funds generally do not, and many index funds also have a minimum investment requirement. So you could buy and sell an ETF whenever you want, whenever the stock market is open. But many index funds, you can only buy or sell once in a day, and so they have just different restrictions. So generally, these work similarly in the sense that you're getting exposure to a number of different stocks, but the thing that you're investing in and the way that you invest in it is slightly different. Now, I personally, again, I'm not telling you what to do because, well, I'm just a random guy on YouTube. You want to make sure you do your own due diligence and never blindly trust a random guy on YouTube. But what I do is I have a passive system where every Wednesday I have cash that is automatically pulled out of my checkings account and it's invested into a number of different ETFs. Now, in this ETF portfolio that I have, the biggest chunk of it is my dividend ETF portfolio. So I have a number of different types of ETFs. I have dividend ETFs, value ETFs, I have innovation growth tech ETFs, that's more risky. And then I also have some emerging market ETFs, more as a risk again, and also kind of a protectionary thing because these are companies and countries outside of the United States that operate in currencies that are not the dollar. So it's another type of hedge, again, higher risk, but also higher potential reward. So understanding kind of how this low and high risk model works. But in this ETF portfolio, my largest piece of it are my dividend paying ETFs because I like the cash flow. Like I said earlier in the video, cash flow funds the guac flow. So my ETFs are there where every Wednesday I'm working to buy more of these that pay me with more of that cash flow. Then in stocks, this is where you got to understand that investing in stocks is riskier than here because now you're investing in individual companies. If you were to take all of your cash and put it into the Amazon stock because you love what Amazon does, and then 10 years down the road, Amazon goes bankrupt, when all this money you put into the Amazon company is gone. But if you put that money into an ETF that has Amazon in the ETF, and then Amazon went bankrupt,
Well, yeah, you might see a little hit on the ETF, but there's hundreds of other companies in the ETF, and then the ETF would kick out Amazon and put another company in. So you have less risk here, but higher reward and higher risk here. Because now if Amazon were to take over the world, well, now you're going to see a bigger return on your stock portfolio. So this is going to require more work on your end. This is a much simpler way to invest, and it's a great way to invest for regular people. This is now going to involve more time, more research, and also more risk, but also more potential upside. And this is where now you have to be honest with yourself and understand, are you willing to take on that risk and are you willing to put in that work? Because if you do, then great. But now be willing to put in the work, be willing to put in the research, and be willing to lose, because the more you lose, the more you should hopefully win. So I invest in stocks as well. This is a different strategy for me than here. Here, I'm investing every Wednesday where cash is just passively invested. Doesn't matter if the market's up or down. This is happening all the time. You don't change this passive strategy. Here, it's a little bit different. Now I'm looking for undervalued companies that I believe will have more value in the future, and then I would come in and buy. So it's not passive where it's automatically happening. I'm looking for an investment opportunity where I believe a company is undervalued. That way I can come in and buy. With real estate, this gets a little more risky because now when you want to invest in real estate, you can't just put $100 like you can into the stock market. You're going to need access to more cash. You're going to have to buy an actual property. You're going to have to be more involved. You have to build a team. So it's much more involved. However, with real estate, I own my actual properties. I invest in real estate. I invest in residential real estate, single-family homes, and I invest in multifamily, and I have invested in mixed use as well, but now kind of focusing in on the residential multifamily apartments and single-family homes. It takes a lot more work. But some people will argue that you actually have less risk in real estate because you own something tangible. You own the actual building, you own the land, you own bricks, you own windows, you own the actual thing. But for the purposes of the example, I'm going to put it further down here because it takes more work to get started with real estate investing. However, the benefit of real estate is you also get cash flow. When I invest in real estate, I really don't care what's going on in the housing market. I don't care if home prices are falling or going up, because what I'm looking for are my cash flow returns. I'm looking for my minimum 7% cash on cash return on my money. If I don't see these types of returns, I'm not going to buy the deal. And the nice thing about real estate is you also get a lot of tax breaks. The reason why wealthy people love investing in real estate is because real estate offers some of the biggest and best tax breaks that a tax code has to offer. How do I know this? Well, besides the fact that I see them, it's also because I'm a licensed attorney, although I'm not your attorney. So real estate has some of the best tax breaks and you get cash flow, which is why wealthy people love investing in real estate. And the goal, just like with everything else, if you can get the cash flow, the goal is also to invest your money in a good area. A good area means where people want to live, where more people want to live in the future, and where businesses are moving to. Again, you can start to see the amount of work required because you're going to have to put in the effort to study these things, and it might sound really difficult now because your first deal is always the hardest. Doesn't matter where you are. The first is always the hardest because you have to learn all the ins and outs of how the process works. But once you start, you're going to start to see all the different ways to do it. Once you put in the work, you will figure it out. So with real estate, if you can invest in a good area where people are moving to, well, now what happens? People want to move there. Your rent prices go up. Your property values also go up. Now, of course, you have economic factors. There are times when real estate prices go down, so you can't always expect home prices to go up. You can't always expect real estate prices to go up. However, over the long term, just like with stocks, just like with ETFs, over the long term, if you hold on to it for long enough and you have a good investment, well, what we've seen is even if you buy at the worst time, over the long term, that investment value also goes up. So you can get the cash flow and the increase in your principal value, the increase in your investment value. Then even more risky is you can invest in your own business idea or you can invest in startups. Now, not everybody is meant to be an entrepreneur. However, you can invest in entrepreneurs. There are so many platforms on the internet that allow you now to invest in startups with as little as a couple $100s. I'm going to name you a few. I'm not sponsored by them, just telling you who they are. One is Republic, one is Start Engine, and the third is WeFunder. And as a little bit of a disclaimer, I am an investor in the WeFunder company. So what do these allow you to do? Now you can invest in these startup companies, and if these startups get acquired, meaning they get bought out, or they go public, well, now you could see potentially a big payday. If they fail, you get nothing. And this is where understanding high risk, high potential reward. Most of these startups will fail. The statistics tell us that almost 9 out of 10 startups fail. However, if you can find a good company that does make it out, well, now you could see huge returns. So understanding where on this risk and reward spectrum that you want to be, and then also understanding, does your investment strategy align with your goals? Now, at the very minimum, if you're just getting started, what you want to do is put aside 15% of every dollar that you earn into your investment portfolio. Now, this doesn't mean that you have to automatically invest this money as soon as you get paid. What this means is as soon as you get paid, 15 cents of every dollar that you earn is going to be put aside to be invested. If it's going to go into this passive strategy, fine. Make it automatic where this 15 cents of every dollar that you earn is automatically invested. There's a ton of apps out there that allow you to do this for free. If you want to be more actively involved in investments, fine. But now take that 15 cents of every dollar that you earn and have it automatically pulled out of your checking account and put it into a separate account, a separate bank account where now this cash is sitting there waiting to be invested. Where the sole purpose of this money is to be invested, you're just looking for a good opportunity. Where now you have the cash to invest, you're putting aside cash to invest, you're just looking for the good deal. But in order to make this work, you have to have the discipline to first put aside that 15 cents out of every dollar that you earn. And then as you start generating this cash flow, if that's how you're investing, now your next question is, what do you do with this cash flow? Are you going to take this cash flow and reinvest it back into your assets, that way you have more cash flow, or are you going to take this cash flow and start using it to live your life? Now, in the beginning, you're not going to have much cash flow. Maybe it's going to be $10 a month, maybe it's going to be $10 a year, but it's still more than what you had last year. But then, if you keep reinvesting the cash flow, now not only are you working to invest more money to grow that cash flow, but that cash flow that you're getting is also working to buy you more cash flow. So this is where just making that decision of how you want to invest your money and what you want to do with your profits when you get it, because the more sacrifice you put in, the bigger wealth that you can build. Remember the three keys. You have time, you have the return, and the amount of dollars invested. If you're investing your cash flow back into it, you'll have more dollars to invest. And then the way you get your more returns is how you're going to be investing your money. You can't change the time, but you can start today. We're all taught just to climb this corporate ladder. Like we go to school to get good grades, to get a good degree so we could get a good job, and then we're taught to work hard at a job that way we can climb the corporate ladder, that way we can become wealthy. But there's a disconnect there between climbing the corporate ladder and becoming wealthy. Just because you make a big salary does not mean you're going to have a lot of wealth. There's a